Imagine this. The market opens tomorrow and you're not allowed to trade on gut feeling. No hunches. No, I just have a feeling this will go up. Would you still know exactly what to do? Most new traders step into the markets with vibes, screenshots, and hope. A small minority step in with a written trading plan. The difference isn't talent, it's structure. In this episode, you're going to build the first version of your own trading plan. A simple one-page document that spells out your goals, your risk rules, your entries and exits, and how you'll review your performance. By the end, you'll have something you can trade from tomorrow without relying on guesswork. Here's what we'll do together. First, you'll understand what a trading plan actually is and why professionals treat it like a business blueprint, not a quick checklist. Second, you'll see the 4 pillars every beginner plan should cover: your objectives, your markets and style, your strategy rules, and your risk limits. Third, we'll turn that theory into a one-page plan you can actually follow for the next 30 days, plus a simple journal to track your trades. This episode is part 1 of the Proven Strategies series, where each video focuses on one piece of turning you from a random clicker into a deliberate trader. Today, we build the plan. In the next episodes, we'll go deeper into risk management, position sizing, and testing your strategy properly so you're not just hoping your plan works. Let's get started. Think of a trading plan as a business blueprint. No serious business opens its doors without a plan for what it sells, who it serves, and how it manages costs. Yet traders regularly put real money at risk with no written rules at all. A proper trading plan answers a few basic questions. Why are you trading? What markets will you focus on? How much are you willing to risk on each idea? What exact conditions must be present before you enter or exit a trade? And how will you track and review what you're doing? Professional traders treat these answers as non-negotiable. Discipline and risk control are what keep them in the game over years, not the ability to call every move in advance. Across trading books, interviews, and education programs, the same theme comes up again and again. Survival comes before profit. That survival comes from rules, position sizing, maximum daily loss limits, and clearly defined setups, not from feeling the market. Traders who last treat their plan as a set of constraints that protects them from their own impulses, especially on bad days. Let's compare 2 traders. Trader A has no plan. One week they scalp. The next week, they try swing trades. They jump between Forex, stocks, and crypto. After a few losing trades, they double their position size to make it back and blow up their account. Trader B has a simple written plan. They trade one market, one style. They risk a small, fixed percentage of their account per trade. Every trade is logged in a journal. After a losing streak, their risk stays the same, and their plan tells them exactly when to stop trading for the day. Trader B still has losses, but they survive long enough to learn because their plan limits the damage and cuts out most impulsive decisions. So here's a question for you. If you weren't allowed to improvise for the next 30 days, what exact written rules would you need to keep trading confidently? Hold that thought. We're about to turn it into something concrete. To build a useful plan, it helps to understand what's going on under the hood, psychology and statistics. Psychology first. Humans hate losing more than they enjoy winning. That's called loss aversion. In trading, that shows up as moving stops further away, adding to losing positions, or closing winners too early. A written trading plan works like a pre-commitment device. It tells you in advance what you'll do when you're tempted to break your own rules. Now, statistics. Any strategy is a distribution of wins and losses, not a guarantee on the next trade. You judge it over a series of trades, not one outcome. That's why your plan must be simple enough to repeat hundreds of times and clear enough that you can see whether you followed it or not. We'll build your first trading plan on 4 pillars. Number 1, your objectives and constraints. Number 2, your markets and style. Number 3, your strategy definition. Number 4, your risk and money management. Pillar 1, objectives and constraints. Start with your why. Are you trading to grow capital slowly over years, to generate side income, or to learn with a small amount you can afford to lose? Then set your constraints. How much time can you realistically dedicate per week? How much capital can you set aside without touching your essentials? What is the maximum drawdown, the biggest peak-to-trough loss you're willing to tolerate before you pause or stop trading? Pillar 2, markets and style. Decide what you will trade and how you will trade it. Day trading demands more screen time and faster decisions. Swing or position trading uses larger time frames and fewer, more deliberate trades. For a first plan, simplicity wins. Choose one market, maybe a single index, one major forex pair, or one liquid asset, and one style, such as swing trading on the 4-hour or daily chart. Limiting your playground reduces noise and helps you actually learn. Pillar 3, strategy definition, your playbook. It should spell out 4 things: how you identify a trade idea, the exact conditions to enter, where you place your stop loss, and how you take profits or exit if the idea is wrong. For example, your setup might be trade in the direction of the trend when price pulls back to a support area and prints a clear rejection candle. Your stop goes just beyond that area. Your target might be a fixed multiple of your risk or the next obvious resistance level. The important part is clarity. Someone else should be able to read your rules and find the same trades you see. Pillar 4, risk and money management. This is where many traders either survive or blow up. A common beginner approach is to risk a small fixed percentage of your account per trade, often 1 or 2%. That way, no single trade can destroy you. On top of that, set a daily or weekly loss limit and a maximum number of trades. For example, if you lose 3 trades in a day or hit a certain loss amount, you stop trading for that session. Your plan decides when the day is over, not your emotions. Some experienced traders argue that strict rules limit their flexibility. They rely more on discretion and intuition built from years in the markets. But if you're starting out, lack of structure usually just opens the door to overtrading, revenge trading, and inconsistent results. In a moment, you'll see how a beginner used a very basic plan and 90 days of focused practice to move from random trades to consistent execution. First, let's turn these pillars into concrete steps you can follow today. Now let's build your plan together. If you can, grab a pen and paper or open a notes app. We're going to create a 1-page plan you can use for the next 30 days. Step 1. Your why and your limits. At the top of the page, Write one sentence that completes this. I am trading in order to. For example, I am trading in order to grow my savings slowly while learning, with money I can afford to lose. Under that, write your constraints. Starting capital, how much are you using? Maximum risk per trade, for example, 1% of your account. Maximum daily or weekly loss before you stop trading and review. If you want to take this seriously, pause the video now and actually write it down. Step 2. Choose one market and one style. For the next 30 days, what will you focus on? Write this sentence. I trade market using style on the time frame chart. For example, I trade a single stock index using swing trades on the 4-hour chart. Commit to this for a month. If you keep changing markets and time frames every week, it becomes almost impossible to tell whether your plan works. Step 3. Define one setup, just one. This is the pattern you'll specialize in. Write down 4 parts. 1. The market condition. For example, an uptrend where price is making higher highs and lower lows. 2. The entry criteria. For example, enter long when price pulls back to a support zone and prints a strong rejection candle in the direction of the trend. 3. The stop loss. Place the stop just below the support zone or the low of the signal candle. 4. The target. Aim for at least 2 times the risk or the next resistance level. The exact details can be different, but the rule is the same. If you can't explain your setup in 3 or 4 lines, it's probably too complicated for your first plan. Step 4. Set your risk rules. Decide right now what percentage of your account you risk per trade, your daily or weekly maximum loss, your maximum number of trades per day. For example, I risk 1% per trade. If I lose 3 trades in a day or 2% overall, whichever comes first, I stop trading and review. Write those numbers down clearly. These are the boundaries that protect you from one bad day undoing weeks of work. Step 5. Create a simple journal. It can be a notebook or a spreadsheet. Your columns are date, instrument, setup name, entry price, stop loss, target, result in money or percent, and a brief note on whether you followed the plan. At the end of each week, take 15 minutes to review. Ask, did I follow my rules? Which trades matched my setup and which were impulsive? You're not trying to rewrite your plan every week, just to make small, sensible adjustments. Here's a quick case study. A beginner trader decides to focus on one Forex pair with a simple trend pullback setup. They risk 1% per trade, aiming for a 2-to-1 reward to risk ratio. Over 3 months, they take 50 trades, recording each one in their journal. Looking back, they discover something important. Most of their losses come from trades that did not fully match their written setup, entries taken out of boredom or fear of missing out. By cutting those trades and sticking to their best setups, their consistency improves, even though the strategy itself hasn't changed. Before we wrap up, one important reminder. No trading plan, no matter how detailed, eliminates risk. Trading is not suitable for every financial situation, and you should never use money you can't afford to lose. A written plan is a tool for discipline, not a promise of profit. Be mindful of regulation, taxes, and your personal financial obligations. If you're unsure, consider seeking independent financial advice before risking real capital. Let's bring this together. Your first trading plan doesn't need to be perfect. It just needs to be clear, written, and followed. Think in 3 key words: clarity, rules, review. Clarity means you know your objective, your constraints, and your chosen market and style. Rules mean you've defined your setups, your entries, your exits, and your risk limits. Review means you journal your trades and regularly check whether you're actually following your plan. If you've written even a rough version of this while watching, you're already ahead of most beginners who never formalize what they're doing. You now have a version 1.0 of your trading plan. You can refine it, but you no longer have to rely on guesswork. In the next episode of Proven Strategies, we'll dive deeper into risk management and testing. You'll learn different ways to size your positions, how to protect your account during drawdowns, and how to backtest and forward test your plan using historical and live data. So if you want your plan to be more than just words on a page, make sure you don't miss that. Your action step today is simple. Turn this into a physical or digital one-page document. Copy the structure from this video: your why, your constraints, your market and style, one setup, your risk rules, and your journal template. Finish it today, not someday. Then share one rule from your plan in the comments below. It might be your risk per trade, your daily loss limit, or your setup definition. Putting it in writing and sharing it adds accountability. If this helped you take your trading more seriously, hit like, subscribe, and turn on notifications so you don't miss the next episode on risk and testing. Trade carefully, stay disciplined, and treat your trading like a real business. See you in the next one.